Hey traders, Jason here from Leavitt Brothers. 2 weeks ago I made the case that a local top was likely being put in place. There was a big divergence between the small caps and large caps. The internal breadth indicators had declined, and there was a complete lack of quality setups to be had. The market didn't have to fall hard, but I made the case that it wasn't going to move up. It turns out that it did fall hard. Not a surprise, the warning signs were there. Now we're getting some indications that a local bottom is being put in place. The indicators are stretched enough to the downside for me to believe we're going to get a rally soon. Now how far that rally goes and how long it lasts is not yet known, but in this video I'm going to outline what I'm looking for. So first let's take a glance at the indexes, then we'll look at some indicators. Alright, so here's the S&P 500 and the Russell 2000, both weekly charts. You can see that the moving averages here are the 50-week moving averages. You can see that they've been really important going back several years. Okay, you see the S&P here, you got a nice bounce there, bounce there, bounce there, same there, there. With the Russell, you have resistance there, bounce there, bounce there, bounce there, bounce there, bounce there. Okay, so obviously these have been really important levels. Okay, so zooming in right now, S&P sitting right at the 50-week. Okay, trying to find some support there. Overall, market's in an uptrend per the S&P 500. You look at the Russell, it sliced through its 50 and is now below. Okay, it's not just a little below, it's actually kind of far below. Okay, this is going to be a big resistance level on the way up. So when we get a bounce, this 1600 level where the 50 sits is going to be a tough level to get through. Okay, it puts the market in a tough situation because while the S&P simply fell to its 50-week moving average, it can bounce and can continue to trend up, and it would be business as usual. The small caps are going to have a lot more resistance and are going to fight it. Okay, so the large caps might want to move up, but the small caps might say, no, we're not ready. We need to rest here. We need to get rejected. We need to do a double bottom. Too much resistance up here to get to overcome. So it's going to be something to watch out for, is like the battle between large caps and small caps, because the large caps could be ready. Small caps probably won't come along for the ride, at least not initially. All right, let's look at the daily charts of a bunch of indexes. I'll go through these fairly quickly because they look similar and they tell similar stories, although there's a difference between them that I'm going to point out as we go. So here's the Dow. The blue lines are the Bollinger Bands with the 50 instead of a 20. Normally you use a 20, we use a 50 here. And then the red line here is the 200-day moving average. So obviously the Dow sliced through its 50-day moving average and came down and met both its 200-day moving average and the lower Bollinger Band where it's trying to find some support. So this is a good place to find some support. Okay, the lower band has operated as support before. Why not now? It could happen again. In any case, the index has fallen enough to justify or to believe that, hey, the easy money has been made to the downside. Path of least resistance. You know, you can see the market neutralizing here and giving us a bounce. If we look at, let me see here. Okay, so if you look at over here, but one thing I want to point out is just because we get a bounce doesn't mean it's going to last that long, and doesn't mean it's going to immediately go back up. I mean, if you follow the Dow here, we got a bounce over here. Okay, it got above the 50. With, you know, the center band, got below, then it got rejected right over here. Then it came down and revisited the lower band, came back up and barely peeked its head above. Then we got another test of the lower band. Then we finally got through it and then came back down and tested it from above. Then came down and put in a higher high. And then this is where weird things kind of happen. It had one more dip before it continued on. So notice this up and down action where twice it got rejected by the 50, then comes down, gets scooped up by the lower band, gets rejected again, comes back down for a double bottom, finally gets above it, and then has to test it from above before it can put in a new high. Okay, so just because even if we bounce here, you know, we could bounce here, we can get rejected by here, we can come back down and get you know, another bottom. Or even if we go higher, we're going to need to come down and test this level before we go higher. So don't expect a smooth ride. Okay, let's move on. Next chart is the S&P 500. It has sliced through its lower band, trying to find support near its 200-day moving average. Similar story here, where from the bottom here, you do get, that's not the line I wanted. You do get pushes above the band there, which are you know, the center band, but it still had to come down and test, gets rejected here, comes back down, finally gets above, but then has to test it one more time before it puts in a higher high. So, you know, the point being that it's not necessarily going to be smooth right up. It could take a couple of attempts. All right, here's the Russell 2000, totally sliced through. It's 50 over here, a lower band there, 200-day here, tons of resistance level. Small caps were weak for a while. They were obviously lagging. It was one of the things that it was one of the reasons why I did the video 2 weeks ago. Even if the large caps are sitting at their lower band, they're sitting at their 200-day moving averages. Even if they want to move up, there's going to be a lot of resistance here. Okay, so you know, we can get rejected by the lower band here. We can get rejected by the 200. We can get rejected by the 50. It could be all the above. It could be some of the above. Okay, we can move up and get rejected by the 200, come back down and test the lower band, and then come back up to the 50 and come back down and test the 200 again. I don't know what path it's going to take, but just the fact that there's all these levels above for the small caps is going to pose a problem for the large caps. Even if the large caps want to move up, the small caps are probably going to stand in its way. All right, mid cap, same thing. So I'm not gonna beat a dead horse here. Big move down, lots of resistance overhead. Okay, small caps are unchanged going back to the end of, you know, last November. So anyone who just simply bought, you know, they haven't made anything. Even if you bought at the low in February, you're barely up a little bit. So just like the small caps are going to pose a big issue, the mid caps are going to do the same thing. Nasdaq here, notice how nicely it trended between the bands. You know, bottom band, top band, bottom band. You know, peaked ahead here, got rejected, came back down, finally got back above. Okay, rode up here. We got test here, top band, test here. You know, test here. You know, rode along it over here, and then finally just sliced through everything. So these are going to be resistance levels on the way up. Right now, we got the 200 as resistance. We got the lower band as potential resistance. We got the 50 over here, which is the center band, as resistance. Again, even if the market wants to move up, there's going to be some resistance levels to deal with. All right, let's get into some indicators. S&P 500 up top. We have the 10-day moving average of the 80 line in the middle. We have the cumulative 80 line down below. Okay, so you guys have, if you've watched my videos before, you kind of know the routine. When the market is doing well, you tend to get the 80 line just kind of rolls up and down within a range, mostly above zero. It does peak a little bit below zero on occasion, but it stays mostly above zero, and this is a sign of a strong market. Okay, this is a characteristic of a strong market, is you get the 80 line just kind of rolls up and down, mostly in positive territory. The cumulative 80 line obviously just trends up. Things changed in the last 2 weeks where we got a big move down. Okay, kind of similar to what we have here. It is definitely low enough to support a bounce, and what I'll be looking for is, you see over here we had a big bounce above, came back down and tested zero, a bounce again, and that supported this area over here where the market came down and moved and went up to a higher high. But notice over here then we went back below zero, and that's when the market also went below zero. So going forward, if we get a bounce, when we get a bounce, we're going to get a bounce. It's going to happen. It's just a question of when. If we come up and get rejected here and then come back down, the market's going to leg down again. Okay, there's no question about it. But if we move up and can get above into the box and come back down and test the bottom of the box and actually just kind of stay here and just trade up and down in the box, then the market's going to be in good shape. Okay, whatever this indicator does, the market's going to do the same thing. Okay, if it can get up into the box and hold that level, then we'll be fine. If it gets rejected by the box, or if it enters the box and then falls back out, market's going to do the same thing. All right, S&P 500 up top, new highs in the middle, new lows down below. I made the case last week that, you know, when the market's healthy, you get new highs up here. When the market's not that healthy, you get new highs like here. And even though the market had been healthy for a couple months, like, new highs should have been printing up here, but they're not. They're printing down here. And you can see that they've been not only printing down there, but they've been trending down for like 2 months. And that was one of the problems. That was one of the reasons why I said 2 weeks ago that we probably have a local top being put in place. Now, new highs don't do us any good right now, but the new lows do. When you get spikes and new lows, you tend to get local bottoms. If you match up let me turn off these so we can see, you know, you get a spike here and that kind of matches up with this bottom. You get a little spike here and that matches up a little bit with that. You need a double bottom. You get a spike here. Each one of these like higher prints kind of matches up. We got a huge spike here, which kind of matches what we got here last February. It's definitely enough capitulation to support a bounce. But in order for a bounce to last, you need AD line to do better. Eventually, you're going to need new highs to do better. You're going to need lots of volume to come in. So this indicator tells us that the market is stretched enough to the downside to support a bounce. Then it's going to be time for the bulls to step up and actually buy, as opposed to just getting you know, kind of a weak bounce. If when we do bounce, if the new lows go back down to a really low level, that's great. If the new lows hang out at a decent level, they come up here, they're over here, then I'll be a little bit iffy, because if the market bounces, you should have a lot of stocks bouncing too, and you shouldn't have new lows printing at a high level. So this tells us we're going to have a bounce soon, and then we'll just have to let the thing tell us how far it's going to go. Okay, here is the high-low differential. So it takes the number of highs minus the number of new lows, charts it as a cumulative curve. We got a turn down recently here. Okay, so I'm going to box this in, color it. Okay, you can see right here that it turned down and it's starting to distance itself from the 50-day moving average. Now, I want to compare it to 2 times in the past. If you look back to 2015, the high-low traded over here below its 50-day moving average, and then it continued to trend down, put a lot of distance in between itself and its 50 at the same time that the market trended sideways. So there was some deterioration up here while the market was sideways, and then of course the market just collapsed back then. Okay, and then even when the market bounced, I'll highlight this, even when the market bounced here, you still had a continuation of the move down over here. Never got above the 50, and that of course led to the market collapsing again over here. It wasn't until March where you finally got a cross up that the market actually improved, its health improved, and then the market actually ended up trending up. So over here, earlier this year, we got a trend down, but if you'll notice that the 50 and the indicator basically just stayed flat. The indicator did not continue to trend down. It moved down a little bit and then it flattened out. Okay, so that told us that even though it turned down, it wasn't that bad, and the worst was probably behind it. Maybe, you know, you get a neutral period for a while, and that's exactly what happened. So what I'm looking for here is, does the indicator continue to trend down? You know, are we going to get something like this, where this thing kind of trends down, and then the moving average is like this, and you get this distance that builds? Because if you have that, it's similar to back in 2015, then the market's not going anywhere. The market's going to probably not only not go anywhere, it's probably going to leg down again. But if this thing can kind of curl around and flatten out and do this, and the moving average kind of flattens out like this, then we're probably just going to get a neutral period that lasts a couple months, and then the market can move up. Okay, so look for the distance between these curves and see if the cumulative high-low continues down or if it can flatten out. All right, different look at the new highs. This is the 10-week moving average of the weekly new highs at the NYSE. I wanted to point out just the absolute level we're in. Okay, when the market was strong, we get like lots of new highs up here, but look at this. The market's been trending up for several months. Just a few weeks ago, we were making new highs. We made several new highs in August, new highs again in September, and yet the weekly new highs are printing at a relatively low level. I mean, like right over here, the market was making an all-time high, and yet compared to, you know, you'd never know that relative to its previous prints. It's something I want to point out here, that in the immediate term, it doesn't do much for us, but in the long term, if the market actually does come down and bottom and we get a bounce, and maybe we get a double bottom, and then we come back up to new highs, and maybe the market does well into 2019, and if the weekly new highs don't do something like this and actually start printing higher levels, then I think we're going to get like a major top in 2019. Not ready to call that right now, but if indeed the market improves here and goes up and the weekly highs don't, then we're going to have like an even bigger top form next year. All right, bullish percent chart. A couple more to go here. I'll go fast. Bullish percent chart dropped to its lowest level since early 2016. it's going to need to improve. Bottom line, it needs to improve. If the market bounces and this thing simply just kind of rolls up like this and doesn't really go anywhere, market's not going to go anywhere either. Okay, there's a lot of evidence. There's a lot of times where this where this indicator has improved quickly and moved up fast. Okay, you can look over here at like 2016 where where this thing went up fast, and 2016 earlier went up fast, and even here it went up pretty fast. So if this thing goes up fast, then great, the market's going to be in shape. But if it doesn't go up very much, then we're probably going to get something similar to 2015, where we had at least a double bottom separated by 4 to 8 weeks. Two more charts. All right, percentage of SPX stocks above the 20-day moving average. Just want to point out that this is another one of the reasons why I believe that we probably are close to a bottom here. Okay, this indicator plunged. It's at its lowest level since it hit earlier twice this year. Only 5% of stocks are above this moving average, so things are very stretched to the downside. You could definitely see a bounce coming. The easy money has been made to the short side. You definitely don't want to be late to the game playing, going short, and then suddenly the market rallies. So be careful. This is an indicator that tells you that, hey, things are stretched to one side, and you want to be careful because there may not be too much more to go. Similar concept here, percentage of SPX stocks above their 50-day moving average. Same story, really stretched to the downside. What I'm looking for here is just to see how, what happens when it bounces. Okay, you can see in February it bounced, got rejected by a box. What I do is I characterize uptrends. Okay, when the market trends up, we get oscillations within this range, and that kind of defines an uptrend. So I'm looking for the ability to get back into that box. You can see in February it moved up, it got rejected by the box, came down, and again got rejected by the bounce, and we went back down low. So the inability of the indicator to get back up in the box told us the market probably wasn't ready. Even in March, April, couldn't hold the box. It went up here and then came right back down. So the market really didn't start a trend that lasted until like right around here in May, when we finally got into the box and stayed there. So what I'm looking for here is when this thing bounces, is it going to get rejected? Are we going to do one of these? Or is it going to be able to get up into the box and actually, hold the level? All right, so that's what I'm looking for. Like it's going to bounce, the market's going to bounce, this is again, it's going to bounce too, and the question is how far does it go and can it hold its level? All right, thanks for listening. Hope you got something out of it. If you like the video and want me to do more, give it a like and share it with your trading friends. You can also subscribe to the channel right here at YouTube. Come check us out at Leavitt Brothers, where we provide trading ideas and market analysis to independent traders, funds, financial advisors. Again, thanks for listening, and I'll see you next time.